Welcome to the Folio Property Podcast with my co-host, Lachlan and My name's Reece Bettle. We're excited to today have a chat about the debt reduction strategy.
Yeah, it's a focal point of portfolio builders and probably one that's underestimated. I think everyone's got their eyes on the prize of building out this mammoth portfolio.
Yep.
Everyone forgets about prime place of residence and how the boring debt reduction strategy, where it fits in the portfolio.
Yeah, and it's some bold calls, I think, that when we're speaking with clients and clients you've successfully helped over the years, it's that kind of that buzzword of like, how do you pay your principal place off in 6 years? Is that possible? Is one question we'll probably unpack today as well. But you do see a lot of that through social media, whether that's finance brokers or advisors or property experts out there, or so-called experts. But, you know, that's a key thing I'd be keen to talk about. Is that possible? Can you pay off your principal place in 6 years using a debt reduction strategy?
Yeah, we'll unpack that today. But I think what's overstated is more these Atlantic statements about building out $5, $8, $10 million portfolios without addressing the fundamentals to start with. And that's where I think people get carried away. They're all about wanting more. Today it's about actually doing the opposite. It's having less in terms of having less debt, having less exposure, but paying off your prime place of residence for me and the thousands of clients we've helped over the years is one of the first steps in a portfolio development strategy that we recommend.
Yeah, and that's something you've kind of said from me day one. The first strategy is to pay that off. Like,
yeah.
Everything else put aside, whether you want to be this property mogul and you want to think about passive income at retirement, your first strategy's got to be pay off that principal place.
Yep. Anyone that comes into my office and we go through this and I see debt, when they fill out the fact find, I see debt on their primary place of residence. That's where our focus is. How do we get that down to zero? Because the reality is, you talk about good debt and bad debt. We want the right type of debt and the structuring of the right debt. Unfortunately, we've got a podcast with Nathan Hood around tax and being advantageous with your tax in a coming show, which will be really, really exciting for those listening, because it's important that everything's structured correctly. Referring to that bad debt versus good debt and how to maximise your tax position is really, really important. So when we look at good debt versus bad debt's the obvious ones, and that's getting rid of all your credit cards, any HEX loans that are hanging around, because people don't understand the implications that alone has on your serviceability. And for those that are new in the property game that are carrying card debts, credit card debts, or HEX debts, although HEX, with the new scheme isn't factored into your capacity, which is helpful. But those bad debts really do restrict your ability to borrow, which helps, obviously disadvantages you trying to build out a portfolio. So that's the first part of it. But the good debt versus bad debt is common questions we get asked. What actually is defined? Well, your household debt on your prime place of residence, albeit it's good debt in the sense that you need it to have a home, to have a prime place of residence. It's bad debt from a tax position, because there's nothing that we can claim. There's no negative gearing tied to that. We can't claim depreciation. We can't claim any costs that are spent on the property. We can't claim any of that interest. So there's we don't want if we have a portfolio, and sometimes it's quite strange. I'll get a client come in and they'll have 3 or 4 properties, and they will have an LVR of 80%. So still owing 80% of the home on their home, and yet they'll have an investment property completely paid off. They'll have 30% LVR on another one and 80% on the other. And the advice has either come from their accountant or mortgage broker. And straight away, it's like, why is this structured this way? Yeah. There is, straight away, we can save, in excess in some of those scenarios, $20,000 to $50,000 a year, depending on how much debt they've got, just by restructuring it. So then they've got more debt on their investment properties that they can claim, negative gearing, depreciation, those sorts of things, and less debt on their home.
Yeah, and when you're I guess when you're speaking with your clients over the years, everyone's going to have a different goal in mind in terms of when they want to get to that retirement point, or when they want to, short-term goal, pay off that principal place. You come up with strategies to help them get there. On the, what's a typical time frame that when you're speaking with a client that you can recommend a strategy that can get them to the paying off that debt, say under 10 years or the 6-year figure that we've been floating around?
Yeah, well, obviously it depends how large that debt is in scale to their income. Yep. So if you've got a combined income of 300K, ideally we want that debt structure on the primary place of residence to be no more than 900,000. There is creep for that. 3.5 is sort of the threshold. Once you get beyond that, you're chewing up your investment debt, and it makes it very difficult for those looking to build out a portfolio and pay off that debt quickly. It makes it really difficult because you've got no levers to pull. Once you've chewed up all your serviceability, well, you're paying that sucker off for commonly 30 years. Now there's loan terms of 35 years. In America, there's loan terms of 50 years, and you can just see banks will go that way because they want to extract more money from you. So yes, to answer that question in part, 3 to 3.5 is the figure you should be working towards. So that's the debt you want on your primary place of residence, your debt to income. And income does include income from your rental properties, additional income if you've got a side hustle or you've got dividends from shares, etc. But that's the 3 to 3.5 is where we want to stick to. So if I've got that debt sitting at $1 million, my loan terms at 25 years, my loan terms at 30 years, it's common practice that is the norm. You buy a home and you spend the next 25 to 30 years paying that off. It's crazy. And we're going to sit here and maybe when I get to 55 or 60, I'll finally be debt free. And for most people, I think owning your home outright is the definition of financial freedom. I really do. And the ease that seeing clients go through that journey and they get to that milestone, it's like once you've done that, what else really matters? Yes, you can go and conquer the world and buy another 5, 6 properties and try to take on more debt, go and get commercial properties. Everything after that can take place. But that moment, and sometimes with clients, we've gone through various strategies where it has pushed them a little bit in terms of their comfort levels, pushed them a little bit in terms of their stress levels to fast track that debt reduction strategy. But when you get there, it's just this moment of clarity, and often it's just enjoy it. Have a year of not having any debt, because it's a lovely place to be. I haven't been there for many years, and with my thresholds at the moment, I won't be there for a while. But that moment of clarity is really important for people. So we want to get as many clients as we can to that position first off. And it's not going. My goal with clients isn't going out there to buy 100 properties tomorrow. It's not going out there to build a $20 million portfolio. My goal is to get them to zero debt on the primary place of residence as soon as we can.
And what sort of, you mentioned, you kind of loosely alluded to, potential scenario where someone could be aggressively paying it off and it might have a bit of pressure on their finances. There might be tight budgeting there. What sort of mindset someone got to have if they do want to pay off that principal place? Is it, like, when I say pay off the principal place, I mean, within that 6-year period or 7 or under 10. So quite aggressive in terms of the 25, 30-year loan.
Under 10 is the target. Yep. We've been able to exceed that and often do that 5 to 7 year mark.
Yep.
We've had one recently, we did it in 3, but that was a really aggressive strategy.
Yep. How'd you do that?
Again, they took on a lot of debt to get there, and that's the counter productive nature of this, right? You have to take on more debt to relieve debt. So a particular client of ours had a home in Geelong. They had close to $1 million worth of debt on their primary place of residence. We then purchased 3 assets for them. Their debt to income on that was at about 2.5. So the beauty of that, the debt to income was so low on their primary place of residence, it gave them so much surplus capacity to buy investment properties. And so people listening, like, okay, you're telling me that it's a debt reduction strategy, yet I have to take on all this debt to get there. Yeah, that's the nature of it, because they were on track to pay that mortgage off in 25 years. Kids are at an age, over the last 5 years where I think they've got 3 children, 2, 5 and say 7, but there's no private school fees yet. All the large expenses that are coming in 3 to 5 years' time. So they don't want to be paying off all that debt when they're putting 3 boys through private school, right? So the strategy was we want to be as aggressive as we can. We're making really good money. We're both back at work, and we both don't want to work forever. So how quickly can we do it? So the strategy was a 5-year strategy to get that down to 0 as quickly as we could. We certainly didn't anticipate, we're going to get the full $1 million in 5 years, but that was the play. Purchased one in regional Western Australia, so Rockingham. That one there for $350. Recently sold it for $700. So after fees, there's $300,000 off the table that you've taken off the primary place of residence. Bought another one in Perth, in Maylands. Purchased that for $650. That is now on the market and looking to get close to 1.1. So that will do a fair bit of the heavy lifting. And the other asset they bought and sold and traded within their own market of Geelong. So it was we assisted on the purchase side, but it was a renovation and flip. So they were able to do that in 18 months and extract another 350,000 from that. So once mainland settles and sold, they'll actually be more than debt free. But understand, in reality, it's not as simple as I made $1 million, therefore I pocketed that. You've got to take away your capital gains. You've got to take away your sales costs. So they'll still probably owe $100,000 on that mortgage. But a large portion has been knocked off in a 3-year period. So pretty significant. Obviously fortunate with some market conditions there. Their Rockingham property pretty well doubled in 3 years. Mainlands has done the same with some work, some value add, as we spoke about on a previous episode. All 3 strategies endorse the value add. So we weren't just relying solely on the market. And they did one in their own neighbourhood. And Josh, the client, is quite skilled. So he was able to do a lot of those works in Geelong himself. So there's a perfect example. And the beautiful thing is having a meeting with them recently was, 12, 18 months ago, they nearly tapped out of the strategy because their debt to income got up to about 6.5 times, which is significant when we didn't potentially foresee the interest rate rises. So it was all well and good 3 years ago to take on these properties when interest rates are at 4%. They get to 6.5. That cash burn on a daily basis become real. So our yearly meetings went to 6 monthly meetings, which went to quarterly meetings, which pretty much catching up monthly just for them to hold on and not sell. So there is ways, and this is what it's looking at various scenarios. So we sat down with their accountant, their mortgage broker. They all had prime sites in good markets, and it was prematurely too early to sell. So we restructured some loan to be able to pull out some equity to put that in an offset account, which essentially cash flowed these assets. So does that make sense?
Yeah, definitely. And I think listening to this scenario, when you're looking, you gave good examples there of some properties that you bought, selling them off or they're on the market, flip some as well. In terms of investment debt, should the strategy be to get it to a point where you sell, or should at any point in a rising market you refinance that? I appreciate obviously you're not a mortgage broker, but should there be part of a strategy in a rising market where you refinance, take some of that equity out and put it onto the principal place? Or with this type of strategy, are we looking at letting the market do the heavy lifting, hold on, and then look to just sell, then release the capital from that onto the principal place?
Yep, everything's circumstantial. So the play there was, you've really got to give the asset time to grow. And if we had sold it mid-strategy a year and a half ago, their debt on their primary place of residence now in Geelong would be 500,000 to 600,000. By waiting another 12 months, it's now going to be 100,000. So that is life-changing for them. And that's, that takes some risk appetite. It takes, them listening and sticking with the advice that we gave. So everything's circumstantial. So when we look at the fundamentals of the markets they were in, and this is where we always revert back to the data. I'm not talking on personal biases, what my belief is on the Geelong market or the Adelaide market or the Perth market, Rockingham, for instance. It's on the data. And there was clearly a runway in all those markets, and we believe that they were still very early in the cycle, so that the heavy lifting in terms of that capital growth, more was still to come than had already happened. So the advice was clear. We've just got to find a way to hold on to these assets for at least another 6 months. And we're not going out there saying we're going to hold these for another 3 years. It's like, let's reassess in 6 months, but we're not selling them now, because in 6 months, and that next 6 months, the portfolio increased collectively, another 40 or 50%. Okay, that's fantastic. How are we positioned? How's your cash flow? Are you sleeping? How's your stress levels? Are you managing this? And once we refinanced, we pulled $100,000 out, put that in a spending account in their offset, but they could still access it. Just took all the pressure away, because it was literally, they're going paycheck to paycheck, and they're going, well, our boys are growing up. They eat more than they've ever eaten. We want to take them, to holidays, and we want to do things, and we can't because we're so burdened by these mortgages. But they didn't realise that. They felt like they were probably letting themselves down by having to remortgage and take equity out of a property. They felt that was a failure. And I said, no, that's not the failure. The failure will be when you're forced to sell when you don't have to. And they just probably didn't realise that leverage was there to pull. When I say leverage, I don't mean the sense of debt, but you've got to look at levers. What can I pull? What can I sell at times? What equity can I draw upon? What value add can I make? So what's our options? And in this scenario, it was a simple refi. Pull $100,000 out of the portfolio, which that $100,000 ended up making them another 400 or 500. So return on cash, and they didn't spend that 100,000; they spent like 30 or 40 of it.
Yep.
But having that safety net that there was money and they could live a normal life was game changing for them.
And when you're looking at this type of strategy where you let's just say under that 10-year rule, trying to pay off the principal place, I'm assuming, the example you've provided there, what you were saying earlier in the conversation, these are going to be trading assets predominantly that we're after. Trading assets, are they only capital growth, or can you will an asset that has good cash flow potentially be a trading asset? So obviously has a bit of a potential to have capital growth. Like, is there a clear distinction between capital growth asset and a cash flow asset?
Yep. To answer the first part of that question, it doesn't have to be a trading asset, because you can simply go out there and, again, that example, if they had $1 million of debt.
Equity to work for you, I guess. Yeah.
Exactly. You pull out the equity, and that equity then pays off the primary place of residence, so you're debt-free. You still own the 3 investment properties.
Yeah.
And that was my advice when they sold, right? So they're now under offer or close to on the 3rd asset of the portfolio. But to be fair, and like I said at the start of the podcast, just to see how happy they are and relieved, and they're in such a great position that there's an element in that says I should be just comfortable with that. But seeing where their portfolio will go over the next 12 months, my advice is my portfolio, I wouldn't have sold, because I would have restructured it, taken the debt out and paid off my primary place of residence, geared up my investments so I'm getting better tax advantages from that, so the negative gearing kicks in, depreciation kicks back in. So I've got my debt working for me, I've got my house paid off, and let the portfolio continue to grow. But again, it's case by case, and everyone's appetite, and it's almost seasonal, right? Investing is almost seasonal. You've got to go through seasonals where you've got to roll up the sleeves. It's going to be tough work. We're going to buckle down. We're going to save, and we're going to go hard at this for 2 or 3 years. We know it's not forever. And that's sort of how I try to break it down in years of a property portfolio. There's going to be times where it's tough, and there's going to be times where it's easy. That was a period for them, and they sort of roll up the sleeves for 3 years. And now they get to enjoy the fruits of it for the next, decades, really. And they may not do anything else, and they're going to be comfortable with that, because they're going to live a very happy life and a very low stress life, knowing that they don't have any debt, and they own the house where they're going to live for the next 20 years, debt free.
And that example, you've bought in multiple locations: Geelong, regional WA, Perth. Yep. Like, how critical is it for someone wanting to implement that strategy to understand how the property cycles work? So a lot of these markets are going to be moving at different paces, different growth as well. Like, how important is that going to be for selecting the right asset?
It is. It's so important to have diversification. If they had for instance, they're in Geelong, right, in Victoria, the safe bet for them would have been to invest in Victoria. If it wasn't for the value add plays that they did in Geelong, they would have lost money on that deal. The market conditions alone went backwards, fortunately. The value add play got them out quite well. But if they had invested all their chips, put them on the table, invested in the Victorian market, one in Melbourne, another one in Geelong, or 2 in Melbourne at that period in time, they would have lost money, and not just a little bit of money, 20 to 30% of their portfolio, which would have put them back decades. So again, there's 2 things to learn there. Cycles for this strategy are so important. You can do everything right, but if you mistime the cycle in the market, again, it comes back to the research, you put yourself decades behind. But also diversification, because we can have all the research in the world, and fortunately we've been right for the last decade, but through diversification, you de-risk it naturally. So if we, in that example, one in regional Western Australia, one in Perth, one in Victoria, we have hedged our bets. One didn't perform. And that was the Geelong. The market didn't perform. The value add did, the market didn't perform. Because we diversified into 2 separate markets outside of that, those other 2 assets did the heavy lifting. And my advice wasn't sell Geelong, because now Geelong's representing really good value. So if they had held on to it for another period of time, you'd start to see that potentially shift.
What about rising markets? I think a lot of people get fear of missing out, maybe jump in too late in the game. But can you still buy in a rising market and do well and then exit? So let's just look, elephant in the room. Let's call out Perth for example. What is it, like 80% growth in the last 5 years? Yeah,
like the established market of houses with land has done about 85%.
85%. Where we're looking at the data daily, weekly, and seeing the amount of stock on market, and we can, from the ground level on, we can hear it's heating up again. It feels like it's going on another run. Let's use that as an example. Should people be deterred from investing in an area that has already gone on a run and think there's still value left in the market? Or should you always be trying to pick at the bottom of a cycle? Say, for instance, Melbourne, that we're hearing quite a lot, is just entered into like more of a buying phase there.
Yeah, it really depends on your strategy, where you're at with your portfolio. Recency bias stops people from taking action. If you always look at hindsight, you'll never buy. And the equivalent of that was when we were buying in Perth in 2022, for example, right? We just had a COVID uplift of about 20-25%. Everyone's like, the Perth market's, it's done its dash. They hadn't seen growth in a decade. It's done 20%. It's like, wow.
Yeah.
They can't do any more. Anyone that's bought in 2022 has made at least 60-75%, right? Again, this time last year, the market was doing 2% growth a month. So we'll call it September, October, just before it sort of slowed down a little. When I say slowed down, instead of going from 2% growth a month, it went down to 0.3% growth a month. At that point in time, people saying Perth's done. It's up 70% for established houses. We can't see growth. I've left the market too late. We took a very strong plane in Perth units middle of late last year, buying units for 5 to 550 that are now, less than 12 months later, are worth 850. So there is a theory to buy at the bottom of the market, and absolutely that's been our model for years. But when you buy at the bottom, you won't always know it's the bottom. And for us, it was buying in Perth in 2018. From 2018 to 20, there was maybe 3 to 5% growth. So you arguably say we're potentially too early. So buying mid-cycle is arguably a safer option because you're getting instant gratification. You're getting instant equity.
Yeah, monthly too.
Monthly.
You're probably looking at
Absolutely. So there's a huge
house on like the realestate.com. You're seeing it going up every month, and you're hearing all the the positive talk amongst the media as well. So you can kind of see it instantly. Yeah,
exactly. And in the game we play, where we're trying to build out portfolios, we need equity to do that, right? It's hard to save your wage and then recycle just your wage alone into property. You'd be waiting years. So we need equity. So we need to get equity. We need instant uplift. So buying mid-cycle doesn't guarantee, but it gives you more certainty because you're well off the bottom. There's momentum in the market. And so those examples last year when we'll be able to buy for $550, they're now worth $800,000. That $250,000 equity, we can then recycle into another market. So early in your portfolio, my advice would be buying in markets that are already carrying momentum. So not buying at the bottom of the cycle for your first investment because you may be too early and then you're just sitting playing the waiting game. I need the equity. I can't save enough cash to buy another property. So I would.
And the yields will probably be pretty low as well.
At the bottom of the cycle, the cash flow really hurts. Mid-cycle, they've improved. So certainly for those starting off their portfolios, you want to be buying into a hot market. And it's like, it sounds, counterintuitive, but it's in fact the reality because within 12 months, most of these cases, by the time they're settled, you've got equity that you can recycle. But certainly in 12 months, you can have more than enough deposit and a bit of a safety net to then look at the next market. And then the second or third asset, you can hedge your bets a little bit then and then try to time the bottom of the cycle.
Mm. What about this statement? I'm kind of smiling because I laughed kind of when I was having the conversation, but I spoke to a potential customer and he's like, look, I'm after a unicorn. I'm like, okay, tell me, what's the unicorn? I want 6% yield, minimum 10% growth per year. So this guy here, obviously, there's probably spruikers out there telling him that's an achievable market with an off-the-plan apartment in Melbourne or something like that. But
NDIS, dual key, something. That's,
correct.
Yeah.
But, I mean, it raises a good question. Like that person there, what would you say if he's a first-time investor? What should he be chasing then? Should he be chasing more something with a high yield because he's trying to get into the market? So maybe it's going to be more of a long-term play. Or should he be looking at something that is going to get him a market that we think has legs to potentially get him to that 10% growth?
So, and this is too much noise. Someone has probably promised him that, which
unicorn is
on our previous version of this podcast. I call bullshit.
Yeah,
I call bullshit on the unicorn assets. They don't exist in masses.
Yeah,
you look at the portfolios that we've created. There's deals in there that are unicorns, but we didn't know that when we purchased them. Yeah. We knew they were good deals, and they've turned out to be sensational deals. But the reality is, your first investment is arguably your most important, right? Because that will dictate the length in time you can make your second and third and the fourth. And like I said, in my personal world, my first asset that I purchased, regional Victoria off the plan townhouse, put me back 5 years because it was the wrong asset selection. And that, 5 years is a long time, half a decade, to then exit, pretty much at the same price as what I paid. So a really good learning exercise. So when I look at that, your first asset has to be with the mindset of capital growth. Has to be. So if you're out there chasing yield, there is a place for cash flow, don't get me wrong, and it's important. Typically later in the portfolio piece, we go heavily cash flow through commercial. We spoke about that with Cal Doggett and the ability to generate a passive income from commercial property. 100%. A lot of our clients that are getting close to retirement, that's the strategy we endorse. But early in the portfolio, we need to get equity. We need to get capital growth into that asset as soon as we can, because that's going to set you up for your second purchase. Once we get to 2 to 3, 3 to 4, then we start to have to manage cash flow, a little bit more. Then we have to start to manage cash flow across the portfolio, because you're going to be limited. You're going to hit a cap on your borrowing capacity, not because of your equity levels, because your serviceability. But certainly for your first investment, you can service it. The banks wouldn't give you the debt unless you could service it. So we don't want to go high cash flow, low capital growth strategy. And everyone's like, I want high cash flow, I want high capital growth. Yeah. Just get comfortable. Just get comfortable with the fact that doesn't exist.
Yeah.
There's a world where that doesn't exist.
Yeah.
Yes, there's exceptions.
Yeah. Like I'm sure a lot of the assets, maybe Perth as well, where the yields were good, had that growth. Yeah. But that was just the market.
We have purchased assets that have 6% yields. These regional markets we've participated in, and had 15% year-on-year capital growth. So it has happened, but I'm not going to go out there and say there's a market in Australia where you're going to get this consistently longer term. Let's under-promise and over-deliver, right? So let's assume for the moment that it doesn't exist. It's either higher capital growth and then you're going to take a haircut on yield, or it's going to be lower capital growth, but you're going to get higher cash flow. So that, let's assume the long-term compounding growth rate of most of the markets we participate in is between 6.5% and 7%. And that's the average, obviously, in a rising period of time, or when the cycle is on the rise, it exceeds that. When it's on the decline, it's sub that. But on average, over 30 years, it's 6.5 to 7. If we want assets to outperform that long-term compounding growth rate, we're going to look for higher land component assets. And to do that, you pay more for the land, less for the house. The tenants are going to pay less for those improvements, therefore you're going to take a hit on your rental returns and your yield. So that balance needs to play out. And my advice for first-time investors is be only focused on capital growth. Find a way to service it. Yep. Find a way to make sure the cash flow means you can survive. You're not eating 2-minute noodles. You can get by. Like I said, the banks won't give you the debt if you couldn't anyway, so you're pretty well safe from that point of view. If you've been assessed and approved, they know you can cover the debt. So that's a really good safety net. But there's various ways which we've spoken about, value-add renovations to increase the capital growth. But let's keep the eyes on the prize in the first 12 months. How do we get equity? Because then we can look at the second asset. Yeah. And then I'm okay to look at cash flow assets for the second and third. It's a completely different conversation. But without equity from the first, we're not going to get to property 2 or property 3.
Yeah. And the debt, just going back to the debt reduction strategy, so pretty clear I guess in terms of the strategy, in terms of what you want to be buying, what type of assets to be buying, high capital growth, potentially trading, at least ones where you can activate some of that equity and put it back onto the principal place. I'm just thinking in my head, if someone comes to you early 30s, late 20s, maybe that's their first home that they're aiming to pay off. They're going to upsize in a period of time. So maybe their strategy is always just to be paying off that principal place. They get it down to pay off that principal place debt, but then they go, actually, no, I want that house in the better suburb next to us that's an extra $600,000-700K, so we go again. Is that kind of what you see
Absolutely.
From time to time?
You see the debt reduction strategy play out multiple times throughout a life cycle. If I had to, and every client situation is different depending on when they come to us, where they're at in their journey. But if you look at the masses, if I had to give you the time frame, it would be first purchase isn't an investment property, right? It becomes an accidental investment, as you say. So they go into a home wherever they can afford, and they get into that property. Then they will look to upgrade at some point in time, 2 to 4 years, maybe 5 years down the track, and then they upgrade into that investment property. Just the property they were living in just becomes an investment property. Your favourite saying, accidental investing.
Accidental landlords.
Yeah, accidental landlords. That's a scenario that plays out so commonly. But if you can actually control that a little bit better and have some pre-thought that, hey, that probably will happen to me, so let's put some, a strategy into place to make this work better for us. Because what happens in that scenario is they paid off a lot off their home, then they move, they upgrade, they don't change the debt. They've got high leverage on their primary place of residence now, and they've got low leverage on their investment property. It's exactly what we don't want to do, but I see it all the time. And their broker may not be sophisticated to provide that advice. So let's plan it out. Where you live now at 30, is that where you're going to probably want to live at 35 or 40?
What's your dream location?
It's not, and they're going, oh yeah, we're probably going to have kids one day. Okay, so this 2-bedroom villa that you're in, will that be enough to have the 3 or 4 kids that you hope to have? No. Okay, so let's plan for that. How can we get the debt down to this as quickly as we can? And this may inevitably become a trading strategy. So we buy 1 to 2 investment properties. That $600,000 debt on the villa, we get that down to zero within the 5 to 7 year period. And then we sell down the villa to upgrade and have as little debt as we possibly can on that upgraded property. And then we start the debt reduction strategy again. We buy 2, 3 properties and over the course of 5 to 7 years, anticipate to pay that debt off. And then you'll find there may be a third, and that's the before the downsizer.
Yeah. What about this? You were just saying that in terms of like, I was just my mind was wandering into a lot of conversations I have about this exact scenario where someone wants to buy buy a property in a location because that's where they want to end up. That's their home they want to settle in. And one of the
land banking,
but it might not be in a market. It might not be the right time to be buying it. But that is such a common thing that I've personally got asked where I want to buy in this location because that's the house I want to live in 10 years' time. Like, what sort of advice do you give to clients like that? Would you, because that is an emotional, and in investing we try to keep the emotion out of it, but that is obviously an emotional purchase. Would you guide them towards that? That's what they want to do, and okay, that's what you want to do. Let's try to change the strategy to get the capital growth elsewhere, or would you advise them against doing that and waiting till that's if it's not a rising market, I should say.
Yep, well, that's the strategy I've done myself. Yep. Right, where do I want to be in 5 years' time? I land banked that 3 years ago, and it's a really good strategy when you don't know exactly what you want, but you may know an area that you want to be, because the house that when you've got 1 kid now, and I'm sure you'll have 3 in the next 5 years. What life looks like in 5 to 7 years, and the house requirements at that point. Do you want a backyard? Do you want a pool? Do you want a second level? Things change, and it's hard to foresee, and it puts a lot of pressure, emotional pressure on people to try to make a decision now for a period of time in the future. And most people are never going to get it right. They're never going to be happy, and they miss things, and then they sell, and because the cost of transacting becomes expensive, it was a bit of a lost exercise. By land banking that location, there's a benefit on 2 parts. You get massive negative gearing benefits, because if you're land banking, you don't really care about the improvements, right? So one of the worst houses you can possibly imagine, the yield on it's like 1.5%, maybe 1.4%, like horrible yield. So yes, I have that cash burden, but I get massive negative gearing benefits out of that, right? So essentially the government's propping that up for me. So thank you. And that location, really happy with it. I think it will be a forever location. What the house I put on it one day, I don't know what that looks like. And it changes every year, every 12 months, what I was going to put on there. And the older I get and closer I get to potentially going to that next transition of building, I'm getting a bit more of an idea of what I think I want that house to be. So, and the beauty in a rising market, that property, like the Perth market, has gone up 75, 80%, arguably more because it's purely land value, and land improves higher than improvements. So it's more than doubled. I've locked away the location. I haven't moved. It's been negatively geared the entire time, so it's costing me nothing to hold. That strategy works well. In a stagnant market, and it's hard to foresee, do I recommend do that in a stabilised market? I'd probably shy against it, because again, it's the opportunity cost. That is in its current form, although it's my primary place of residence in the future, in its current form, it is a high land value investment.
Blue chip area.
Yeah. So the idea is, when I bought it 5 years ago, I knew we're entering a rising market. I'd rather pay 5 years ago what the price was worth compared to what it is now. And that turns out it was essentially half the price back then. So I was forward planning that as an investment property. Yeah. But if the fundamentals aren't strong in a market, I would hedge against it, because it's the opportunity cost. My debt's been tied up in that, meaning I haven't been able to invest in other pockets or in other investment types. So no, in a stagnant market, to answer your question, I don't endorse that strategy.
Okay, mate. And then just to kind of summarise then, what would you say to someone who's sitting on a 25-year, 30-year mortgage right now and wants to pay that off quicker? What would be your advice for them to implement straight away?
You need to take on more debt.
Yeah.
Get comfortable with that, because you need to invest in rising markets but you may be comfortable with that. First is, are you okay with that? Just working and paying your mortgage off over 25 years. If you are, that's fine. So this is not for everyone. It's those that have got a clearer strategy, and it's knowing what the next 5 years. Do you have school fees coming up? Are both parties at work? At the moment we are, but we don't want to do that forever. Okay, if we don't have kids, all right, let's work hard before one of us, is at home taking care of the kids while the other one's working. So everything is circumstantial. But in that scenario, you've got 25 years and you do want to pay it off quicker, you want to get it under 10 years, then you're going to have to get comfortable to take on more debt. And we're going to potentially buy 1 to 2 investment properties over the next 12 months and then again in 18 months to have a 4 to 6 year strategy to get your home completely paid off in full.
Beautiful. Just going on back to the roots now for the I Call Bullshit segment. We've had a load of comments over our YouTube channel over the last couple of months. Moving forward, as we've said in one of the intros, please send in any statements.
Bold statements, bold headlines.
Bold headlines that you want Lachlan to unpack, or if we've got a guest on that episode, we might pick the questions that maybe are related. So we've got Nathan Hood coming on to talk about some tax stuff. So if there's any tax questions, please send those in as well. But yeah, I think the one we saw recently, which I quite liked, was essentially you don't need a real estate agent in a rising market. So it was referring to Perth at the moment being on a bit of a heater and the value that a real estate agent is providing. So Lachlan, the question is, you don't need a real estate agent in a rising market. Do you call bullshit?
It's interesting, isn't it? Because in a rising market, the sheer volume of demand, does the selling, right? This is the perception that an agent doesn't do anything. Yeah. People don't realise that selling your own home is the largest form, individual form. So you've got the big agencies in the world, Ray White, Elders. Selling your own home is still the number one agency in Australia. So people don't realise a lot of people do sell their own home.
It's crazy. I didn't know that.
Yeah, no one does. But there's a lot of websites that you can do it. You launch it on there, you take home opens yourself. But it is the number one way people, not that obviously doesn't compare to the masses of agencies, but as an individual agency, selling your own home is number one. But I don't encourage it. Yes, there's good agents out there, equally as there's terrible agents there that don't do a lot. But through every conversation that I have when this gets questioned, if you do have a quality agent that does all the buyer work, creates a really competitive framework and works the buyers extremely hard, they will get a higher price. There's no doubt about it. A really good, well-run campaign will outperform the market. There's no doubt about that. So I do call bullshit in summary. Quality is key. Yes, I do agree that there's some agents out there that have got very comfortable in rising markets, be that Queensland, Adelaide or Perth in recent years, where they do more work in trying to find listings and spend 95% of your time. If you listen to any real estate podcasts, no one's talking about how to get a better price for their seller. No one's talking about how to do a great job. All they're talking about is how to get listings. So that concerns me. That the push in that market is all about listing activity. I've just got to sign listing agreements. The more listings I get, properties sell themselves. So it worries me that that's becoming the image of a real estate agent. Don't get me wrong, but fundamentally, a really good agent that does work for their client will outperform the market and get you the best result. And legally, we could sell our own properties. We're licensed. I'd argue I know real estate pretty well. I think I could sell my own property. Recently, I've sold 2 properties in my portfolio in the last 6 months, and on both occasions, the agents have outperformed my expectations, and certainly outperformed. And their buyer work, when I talk about buyer work, their follow-ups. So, and some staff, shadow in there, go through home opens and see, how active these agents are, because they can talk the talk. They're very good at selling. So they're selling to you as a client as much as they're selling to anyone else. But no, I was pleasantly surprised that the good operators out there are getting better results.
Beautiful. Thanks for listening and joining us on the Folio Property Podcast. Any questions you want to send Lachlan moving forward, please hit the link below at info@folio.com.au. Thanks for listening.